Welcome to our comprehensive video on the risk of ruin. Today, we're diving deep into this crucial concept that can make or break your investment strategy. To start, let's define risk of ruin. Simply put, it's the probability that an investor's capital will dwindle down to zero due to sustained losses. This concept is particularly important for those who actively trade or use leverage. To better understand, let's use an example. Imagine you start with $5,000 and you make trades that either gain or lose $500 with each trade, reflecting a win rate of 50%. The risk of ruin examines how long it might take, if ever, before you potentially lose all your capital. Now, here's a quick question for you. What factors do you think influence the risk of ruin? Write down your thoughts, and we will discuss them shortly. Several key factors influence the risk of ruin: initial capital, trading strategy, win ratio, and the size of each position. These variables can significantly impact the likelihood of depleting your funds. Let's visualize this with some data. Consider three traders with different strategies. Trader A has a 55% win rate, Trader B has a 50% win rate, and Trader C has a 45% win rate. Each starts with $10,000 and trades risking $1,000 each time. As seen in the graph, Trader A is at a 10% risk, Trader B at 50%, and Trader C at a staggering 85% risk of ruin. A higher win rate significantly reduces the risk of ruin. Let's put this understanding into a mathematical perspective. The risk of ruin formula, given a win ratio, W, and loss ratio, L, is often represented by the Kelly criterion equation. By applying the Kelly criterion, one can determine the optimal size of a series of bets to maximize wealth. For instance, if an investor has a 60% chance of winning, the formula will guide them to how much they should bet relative to their capital. One of the common strategies to manage risk of ruin is diversification. This involves spreading investments across various assets to minimize exposure to any single asset, reducing the overall risk of massive losses. Let's take another closer look at a typical diversified portfolio. We have a mix of stocks, bonds, and real estate investments. Assume we distribute capital evenly across these categories. This even distribution helps mitigate risks in case one asset class underperforms. This strategy is extremely valuable in preserving your capital over time. Here's a question. Besides diversification, what other risk management strategies can you think of? Jot down your thoughts. Other useful strategies include stop-loss orders, which automatically sell an asset when it reaches a certain price, and position sizing, where the size of each investment is proportional to the investor's total portfolio. For example, using stop-loss orders, an investor holding stocks in a volatile market might set a stop-loss at 10% below the purchase price to limit losses. Analyzing different stock performance during a volatile market helps us understand how stop-loss orders can prevent significant losses. Notice how Stock B limited its loss to 10%, thanks to stop-loss orders, compared to Stock A's 15% loss. This security measure significantly helps in reducing the risk of ruin. In conclusion, understanding and managing the risk of ruin is critical. It's the bedrock of a sustainable investment strategy, helping you make informed decisions and safeguard your finances. Thank you for watching. Don't forget to subscribe to our channel for more insights into smart investing, and share your thoughts and questions in the comments below.